we are Team 8 and today we'll be doing on the Coca-Cola case presentation. So the order of presentation will be myself, Davina, Ying, Ming, Rachel, and lastly Ting. So the contents of our presentation goes like this. Firstly, we'll look at the background of Coca-Cola. So Coca-Cola is actually the world's largest non-alcoholic beverage company. It owns, licenses, and markets more than 500 brands in more than 200 countries. It also markets 4 of the world's top 5 non-alcoholic sparkling beverage brands, such as Diet Coke, Fanta, and Sprite. And it accounts for 1.7 billion of the 55 billion beverage consumed worldwide every day. So first question, they want us to derive a per share value estimate of Coca-Cola as of Jan 2011, and also to discuss the major steps in the valuation process. So in the valuation process, we'll be looking at the strategy analysis, then the accounting analysis, and financial analysis, and lastly, prospective analysis. Firstly, in the strategy analysis, we'll be doing the industry analysis using the Porter's 5 forces. The bargaining power of supplier is low because there is a high number of suppliers and Coca-Cola can easily switch to another supplier. Bargaining power of buyer is low because individual buyers are not concentrated. The threat of substitutes is high because there is a large number of substitutes, such as Pepsi and bubble tea, and the threat of new entrants is low because small brands are not able to compete with Coca-Cola on the larger scale. The intensity of rivalry is high because there are 2 major players, which are Coca-Cola and Pepsi. Moving on to the competitive strategy analysis, Coca-Cola uses a product differentiation strategy. Its products are priced similar to other substitutes, but they spend a lot on branding and advertising. For corporate strategy analysis, Coca-Cola initially operated in carbonated soft drinks, but they moved on to non-carbonated market and as well as the fruit juice, ready-to-drink tea, and bottled water. For accounting analysis, we will be doing the steps as shown in the slides. So we will have to identify and assess key accounting policies, such as Coca-Cola using activity-based costing or the first in, first out method for the inventory. And then we will have to evaluate the extent of accounting flexibility to determine the reporting strategy and identify and assess any red flags. Lastly, we should also identify distortions, measure, and make necessary adjustments to the financial statements. Next, to move on to the financial analysis, we'll be looking at ratio analysis and cash flow analysis. So under ratio analysis, we'll be looking at the income statement and how it is decomposed by. We can also look at key profitability ratios such as current ratio or debt to equity ratio. Lastly, we should also assess the sustainable growth rate. Under the cash flow analysis, we should see whether Coca-Cola is able to generate positive cash flow from operations and to ensure that the cash inflow from customer is always higher than the cash outflow for investments. Next, we'll move on to prospective analysis, whereby we will do the financial projections in 8 steps. Step 1 is to forecast the main drivers of profit. So we look at the information that is given in the table on the right. To forecast the sales for 2011, 2012, and 2013, we will be taking the sales growth rate that is given in the question, which will be 10%, 8%, and 3% respectively. So to find the sales for 2011, we will take 10%, 110% times the sales in 2010, and we will get 38,720. And we will do the same for 2012 and 2013. In step 2, we will forecast the required working capital and net operating assets. And for this, we will also try to find the beginning net working capital with the information that is given, which is 3% of the sales and for 2012 and also 3% of the sales for 2013. So we will take 3% times the sales in 2012 to get 1254.53. And we will do the same for 2013. For beginning net long-term assets, we will also use a percentage given, which is 105% times the sales. So we'll get 43,908.48, and we'll do the same for 2013. To find the beginning net operating assets, it is just to sum up the 2 numbers above, and we will get 45,163.01 for 2012 and 44,364.29 for 2013. Next, Shi will take over from step 3 onwards.
Thank you, Davina. So for step 3, we need to forecast the capital structure, i.e. the debt and equity used to finance the operations and investment. So the first thing we should do is to forecast the net capital, which is equal to the net operating assets from the previous slide, since there's no non-operating investments. So forecasted net capital will be 45,163 million in 2012 and 44,364 million in 2013. So since we are given the forecasted proportion of both debt and equity over net capital, then we can forecast the debt and shareholders' equity in 2012 and 2013. Next slide. Yeah, so moving on to step 4, we are supposed to forecast the NOPAT. And to do this, we take the forecasted NOPAT margin given to us, multiplied by the forecasted sales amount, which was calculated in step 1. Next slide. Yeah, so for step 5, it is to derive the balance sheet items. So this slide shows the pro forma balance sheet. And all the figures here have been calculated in the previous few slides. So it's just putting everything together to derive the pro forma balance sheet. Moving on to step 6, we need to forecast interest rate, cost of equity, and the tax rate. So the table on the left shows the cost of capital parameters which are given to us, interest rate, which is the cost of debt, and also the tax rate are already given to us. So cost of debt will be 4.5% and the tax rate is 35%. So we just need to compute the cost of equity using the CAPM model on the right, and we will get 6%. So now that we know the cost of debt is 4.5%, we can calculate the interest expense after tax, which is the cost of debt multiplied by 1 minus tax rate and then multiplied by the amount of debt. So to find the net income, we'll take NOPAT minus net interest expense after tax. And this will be the pro forma income statement. So moving on to step 7, we're supposed to make assumptions and forecast the terminal residual income. In addition to calculating the terminal value, we will also need to find the residual income for the years in the forecast horizon, which is 2011 and 2012. So to find the residual income, we will take the expected net income minus the charge for equity. Charge for equity is the cost of equity multiplied by the book value of equity. So after finding the residual income for 2011 and 2012, we need to discount the residual income to its present value using cost of equity as the discount rate. And to find the terminal residual income, we take the residual income in the terminal year divided by the cost of equity minus the constant growth rate. In this case, we assume the residual income beyond the forecast horizon will grow at 3%. So the terminal residual income is 139,249. And to find the PV of the terminal residual income, we divide the terminal residual income by 1 plus cost of equity to the power of 2 to get 123,931.65 million. Next slide. So to find the estimated value of equity, we take the beginning book value of equity plus the PV of the residual income for both 2011 and 2012 and add the PV of the residual terminal value. This will give us 165,214 million. Then we divide it by the number of outstanding shares and we will get the estimated value per share to be 72.08. Next slide. Then so on 31st December 2010, the actual share price was about $23.9. And since the market price is lower than the estimated value per share, the share was undervalued as of January 2011, provided the assumptions made while using the residual income are reasonable. So this set of assumptions will be explained more by Hamin in question 2. Yeah. So all these calculations that we have just gone through represent nothing more than just an estimation of a most likely scenario of Coca-Cola's future. So we should actually consider a broader range of possibilities. And this can be done by considering the sensitivity of the projections to the key assumptions, such as those in the table on the left. For example, Coca-Cola experienced variable patterns of sales growth rate and NOPAT margins from 2007 to 2010, with the growth rate even being negative in 2008. Thus, it is important to forecast the sales and NOPAT using a range of growth rates. So next time, Ming will be explaining the key assumptions used in the valuation process.
So question 2 wants us to actually explain the key assumptions that we're actually making in this process. So let me move on to the first assumption. So the first assumption that we made was actually the cost of equity, which can be calculated with the CAPM model. So it's taking the risk-free rate plus beta times the market risk premium. Note that the market risk premium only rewards you for taking systematic risk, and unsystematic risk is not rewarded. So in our assumption, we actually assume that beta and cost of equity remains constant at 0.6 and 6% respectively throughout the years. Despite changes in financial leverage, this can actually affect the beta, but we didn't actually change the cost of equity. And the tax rate remains unchanged at 35% for calculation of net interest expense after tax. So you can actually see the debt to book value of net capital, the preferred equity to book value of net capital, and the shareholder equity to book value of net capital that was calculated earlier. Next slide, please. So for our second assumption, we're actually making an assumption on the cost of debt. So the tax rate actually remains unchanged at 35% for calculation of net interest expense after tax, and cost of debt remains unchanged at 4.5%, both of which are conservative estimates compared to historical data. For the effective tax rate, we could see that it ranged from 18% to 25%, while cost of debt actually ranged from 1% to 5%. Next slide. So for our third assumption, we're actually going to employ the summary forecasting. So what's the difference between summary forecasting and the detailed forecasting? Let me go through the summary forecasting first. So the summary forecasting actually use condensed financial statements with the line items aggregated together. Secondly, a number of assumptions required are actually smaller. And thirdly, it provides sufficient information for analysis and decision making. While for the detailed forecasting, we're actually using detailed financial statements with individual line items. It's actually tedious and requires larger sets of assumptions for each individual line item. Thirdly, it provides excessive, irrelevant information for analysis and decision making. In this case, we use the condensed financial statements because the case provides for summary forecast of sales growth, net profit margin, NOPAT margin, instead of detailed forecasting of each line item in the financial statements. Thirdly, it actually assumes that non-recurring items are encapsulated, but in 2010, an acquisition of Coca-Cola Enterprise actually took place, and net and NOPAT margin and NOPAT figures include unusual gains, net of unusual losses. Ideally, this should be excluded in NOPAT calculations and forecasts of other values. Lastly, in addition to the sparkling beverage segment actually forms 76% of the product sales, and more detailed examination might actually have been needed here. So moving on to the fourth assumption, the forecast horizon. We're actually employing a 2-year forecast horizon. Recap, what is a forecast horizon? It's actually a period in which a reasonable estimate of future performance can be made. And two, it's actually dependent on availability of information and where there is a competitive equilibrium. Using the 2-year horizon, the following assumptions are made. Firstly, competitive equilibrium is reached within 2 years. And secondly, all ratios above remain constant beyond forecasted horizon. Lastly, residual income beyond forecast horizon actually grows at a constant rate. So the drawback is that it's actually less accurate forecast of future performance. Next, so it's the sales forecast. Why are we making this assumption? It's because sales is actually a key value driver of the firm. It is assumed that sales growth will actually decrease from 10% in 2011 to 8% in 2012 and 3% 2013 and beyond. So we actually came up with 3 reasons for the declining sales growth. Firstly, the macroeconomic factors. Because of a lower demand for soft drinks such as Coca-Cola due to increasing trend of health-conscious consumers. Secondly, industry factors. Saturated beverages market and intense competition from major competitors fighting over the same pool of customers, such as PepsiCo and Dr. Pepper, has actually caused the market to be overly saturated with different types of soft drinks. And thirdly, it's actually the firm-specific factors. The lack of product diversification and slow response time in meeting the demand for healthier drinks has actually negatively affected Coca-Cola's market share. Next, so assumption number 6 is actually the NOPAT margin forecast. Remember that the NOPAT margin is a key ratio in indicating the profit per dollar of sales, and it is assumed to stay at 20% in 2011 and 2012, and then falling to 15% in 2013. So the reason for the decline can be explained in three different parts. Firstly, the increasing cost of corn sweetener and aluminium packaging, both being key raw materials in the production of these soft drinks. Secondly, increasing R&D expenses to meet changing consumer needs due to the increasing focus of health-conscious consumers. $132.8 million was actually spent on scientific research and partnerships between 2010 to 2015. And lastly, the offset by announcement in 2010 of a new productivity program in Coca-Cola's facilities with targeted annual cost savings of 350 million to 400 million. Assumption 7 next. So it's the turnover forecast. So the case facts. Cash and marketable securities is actually part of operating working capital. Secondly, no non-cash operating investment assets. Thirdly, working capital turnover ratio actually remains at 3% in perpetuity. And lastly, long-term asset turnover ratio is to remain at 105% in 2012 and 100% in 2013. So the rationale behind why we actually make this turnover forecast is recall seminar 10. Turnover ratios actually tend to be stable over a period of time, barring major changes in investment management strategy, which was not mentioned in the case itself. Therefore, we assumed this following percentages. Now I'll pass my time to Rachel.
Thanks, Ming. So I'll be going through the last assumption, which is regarding Coca-Cola's capital structure. As you recall mentioned in the seminar slides, the leverage of firms tend to be stable over time unless there's a significant change in debt or equity. This leads us to making the assumptions that the capital structure of Coca-Cola remains constant at 27.75% in 2013 and 72.2529% in equity in 2013, the terminal year. The rationale behind this assumption is that Coca-Cola has no plans to raise external capital via debt or equity issuance. So now I'll be moving on to question 3, which requires us to use the discounted cash flow model to derive a per share estimate of Coca-Cola based on the same set of assumptions mentioned earlier. Lastly, we'll compare the DCF model with the RI model. Next. So the DCF model is actually a valuation method used to estimate the value of equity based on its expected future cash flows. And as you can see in the slide, this is the formula for us to derive the value of equity. So we have actually found the values of cost of equity, constant growth rate, and terminal year. The values were actually mentioned in the assumptions earlier. So now all we need to do is just find out the free cash flows to equity holders. Next. Since the per share valuation estimate relates to shareholders' equity, we will use free cash flow to equity holders. So first, we'll find out the net income, then we'll add depreciation and deferred taxes, less the capital expenditures, and then incorporate changes into the changes in working capitals and debt to finally get the free cash flow to equity holders. Next slide. Yeah, so however, since the case actually gave us the changes in the net long-term assets, we shall use that to replace the depreciation and deferred taxes and the capital expenditure. Next slide. So for the first line item is the net income. So the net income, we actually calculated using the prior year net income times 1 plus the forecasted sales growth, which is 3% for the terminal year 2013. And these are the numbers for the net income as seen in the slides. Next slide. So next, we'll calculate the change in the net long-term asset. The case actually provided us with the ratio of the forecasted beginning net operating long-term assets over sales. So using these respective ratios, we multiply it by sales to derive the beginning net long-term asset for each year. Then can we derive the change in net long-term assets for each year too? So for 2011, the change in net long-term assets is 1.935.48 million. And in 2012, it is 836.35 million. And finally, in the terminal year, it's 1,292.16 million. Next. Next, we'll derive the change in the working capital for each year. The case actually provided us with the ratio of the beginning net working capital over sales for each year. Using this ratio, we multiply it by the sales to get the beginning working capital for 2011 to 2013. And from then on, then can we derive the change in the working capital. So for 2011, it is 11,192.47 million. In 2012, it is 37.64 million. And in 2013, which is a terminal year, it is 38.76 million. Next slide. So next, we actually calculate the change in the debt. So the case provided us with the ratio of the debt over book value of net capital. So using this, we multiply it by net capital of each year to derive the beginning debt for 2011 to 2013. And from there on, then can we derive the change in debt for each year. So in 2012, it is 10,885.58 million. In 2012, it is 221.62 million. And in 2013, it is 369.29 million. Next. So now I'll pass the time on to Ting, who will go through the rest of the discounted cash flow model.
Thank you, Rachel. Using the free cash flow to equity holder formula shown by Rachel earlier, we derive to a FCFE of 5,430 million in the forecasted year 2011, 8,574 million in forecasted year 2012, and 5,139 million in the terminal year 2013. Next slide. Based on our assumption, we assume that the FCF beyond the forecast horizon is growing at a constant rate of 3%. Hence, we then calculate the FCF beyond the forecast horizon by taking the FCF at terminal year divided by the cost of equity 6% minus the constant growth rate of 3% to arrive to 171 billion. After that, we discount all the free cash flow to the present value using the cost of equity. By adding all the present values, we arrive to an estimated value of equity, 165,240 million. And by taking the estimated value of equity divided by the number of shares outstanding, which is 2,929 million, we arrive to a per share valuation estimate of $72.08. Next slide. Moving on, we will now compare the DCF model with the RI model. The per share valuation estimate we computed using the DCF and RI model are the same, which is $72.08. This is mainly due to the same assumption used in both DCF and RI model. The assumption we use for both DCF and RI model are the same forecast horizon of 2 years, same sales, margin, turnover, and leverage forecast, and we also use the same cost of capital. Next. Moving on, to forecast, DCF require analysis to forecast the income statement, the change in working capital, change in long-term assets, and change in debt to derive the free cash flow. Whereas for RI model, we require the full pro forma income statement and balance sheet to derive to the future earnings and book value. Moreover, the basis of valuation for both DCF and RI are different. For DCF, it's based on cash flow underlying accruals where the cash flow is spread over the horizon beyond the forecast horizon. On the other hand, the RI model builds directly on the accrual accounting where the current book value and profits over the forecast horizon reflects the cash flow beyond forecast horizon. Next slide. The DCF model using the current cash flow has lower ability to capture relevant information in the balance sheet such as AP and AR as compared to the RI model which uses the current reported earnings, which has higher ability to capture the relevant information in the balance sheet. With the period 2 point, the DCF model has lower ability to predict the future cash flow, while RI model has higher ability to predict the future cash flow. Next. For estimation risk, DCF has higher estimation risk due to having higher portion of estimation as it involves the forecasted cash flows, resulting in higher possibility of error. On the other hand, RI has lower estimation risk as most normal earnings are already reflected in the book value of equity. Since RM model recognizes more of the total intrinsic value upfront based on the book value, there's a lower possibility of error. The value creation prospect is less clear for the DCF model as the FCF is affected by both current operations results and investment for the future, whereas the value creation prospect is more clear for the RM model as it focuses on key value drivers such as the profit margins, sales turnover, and leverage. Next. DCF and RM model has different terminal value. The terminal value under the DCF model is the present value of expected CF beyond the forecast horizon, where the terminal value under the RM model only includes the present value of the abnormal earning beyond the forecast horizon. This difference in the terminal value is because in RM model, the present value of the normal earnings is already included in the beginning book value of equity. And the last difference is, for under the DCF model, the book value of equity is not required, whereas for the RM model, the capital charge will become positive and will require adjustment if the book value is negative. Okay, so we have come to the end of our presentation. Thank you.